the first two parts, right, we're going to have, chapter 15, we're going to have mainly what we call vertical analysis and horizontal analysis. Okay? So I'll give you the rules on this. We'll start with vertical. Vertical analysis, you got the income statement. On the income statement, the rule is, why don't we do it like this? Divide each line item by revenue, okay, which could be called sales. Okay. And then on the balance sheet, divide, I keep saying divided here, divide each line item by total assets. Okay? So why don't we start with vertical analysis, and we'll do vertical analysis for 2011 balance sheet, and then we'll do the income statement. So we'll start with the income statement. We got sales, cost of goods sold, gross profit. I'm just summarizing it, right? And then we got depreciation expense. We got other expenses, income before taxes, income you got net income. So if I were going to divide everything by the sales figure, sales for 2011 was 1,992,000. So we know that 1,192,000 divided by 1,192,000 is 1, right? Or we like to express this in percentage terms, 100%. Okay. Now if I take cost of goods sold of 1,194 million and divide by 1,192 million, oops, wait. I did the wrong thing, right? That's 60%. Okay. Gross profit is 798 divided by 1,992. And I'm able to leave the zeros off as long as those placeholders are 0 for both numbers. I can truncate the zeros and I'm going to get the same percentage. Right? Now if there was, like if it was 1,992,450, then you wouldn't get the right percentage by shaving those zeros off. But it looks like all of these numbers have 3 zeros at the end, so we can pretty much do that. Depreciation expense is 54,000, and we'll divide that by, okay. Other expenses is 501,000. And then we have income before income taxes is, oops, income tax expense is 42, and net income is, okay. Why would I want to do this? Okay. Vertical analysis also is sometimes called common sizing, or coming up with, this would be like called a common size income statement. So what this does is, say you got these big companies like Microsoft that have billions, like say their cash account has, I don't know what it has, I'm guessing, but maybe 50, 42, and then you got these long numbers, yeah, right? And say you're an investor, okay? You got Microsoft, and then you got something else like maybe Chipotle Grill, which might not be as big as Microsoft. Maybe they're like, I don't know, like in the 50 million, right? Kind of thing. When Microsoft is in the billions and you got another company in the millions, right? Say that's the revenue figure or whatever figure, right? And you want to decide which one you're going to invest in, or you want to compare the two companies, or say you want to compare your company to the industry average, right? It's hard because it's a different league, right? But if we put everything into percentage terms, then you can compare. You can say, well, right, Microsoft's cost of goods sold is 60% of its revenue, whereas Chipotle's cost of goods sold is 35% of its revenue, right? You can analyze companies of different sizes that way. And that's why they call it common sizing. Our common size, this is a common size income statement, okay? But the key is divide everything by sales, okay? Now, when you get to the balance sheet, we're going to divide everything by total assets, okay? So let's see what we got. And I'm just going to run down the list like that, right? I got cash, I got accounts receivable, inventory, we got equipment, accumulated depreciation, you got total assets, that's going to be 100%. Then you got accounts payable, you got income tax payable, you got common stock, you got paid in excess, you got retained earnings, and you got total liabilities and equity, okay? So just do the same thing, right? We're going to say equals, I'm going to do 2011 for you, okay? If we had all the data in a spreadsheet, then it would be so easy just to, right, put the formula in and copy it. But since I'm punching it in here, we'll just get, at least we get the point across, right? So, and again, are they all zeros? Yeah, they're all zeros, so we can maybe make our life quicker, or our work quicker. So I'm taking the 174,000 cash and dividing it by total assets of 1,053,000. Okay, so that's 17%. Okay, and we're just going to go down the list, and the divisor is always going to be the 100 or the 1,053,000 in total assets. And then this guy is showing negative because it's a contra asset account, meaning that it sits over there with the assets, but it behaves in the opposite manner, contra, right? Contra to the assets. So really, that's not a decrease, that's an increase. I'm sorry, really that's showing as a negative because the account is it's a credit balance account sitting over there with a debit balance account. So it's behaving in the opposite manner. Okay. Again, now we're going to take everything, so that includes the liabilities. We're going to divide them by total assets. And paid in excess 198. Did I skip one? I did the common stock, okay. I put in an extra. Okay. So same idea, but we're expressing everything in terms of total assets on the balance sheet. Okay. So for vertical analysis, just remember total assets for the balance sheet and sales or revenue, right, for the income statement. Okay. And it's called common sizing. Okay. So we got that guy in there. Everybody okay? Okay. Now we're going to do the horizontal analysis. Now for a horizontal analysis, you need a comparative financial statement. So we cannot, in this example, we can't do it for the income statement because it's only showing 1 year. But we can do it for the balance sheet. Okay. So over here, I'll do my horizontal analysis. What we need to do is, number one, compute the dollar change, which we might have already done when we were doing the cash flow statement. Yeah, and we didn't save it. And then we're going to complete the percentage change. Yeah. So you could have got 2 birds with 1 stone, but this is a 57 increase. Now this is going to be expressed in dollars, right? So why don't I copy that format, and we'll keep that format in this column, and this will be percentage change. So real quick, see how fast we can compute these changes or recompute. We got I'm going to leave the accumulated depreciation positive. So I'm just getting the difference between 2011 and 2010. If you don't see where what I'm doing. And remember that change in total assets should equal the change in total liabilities and equity. Okay. So we got our dollar changes. How do we get the percentage change? It's not hard, but it's probably the hardest thing about this horizontal analysis. And all you have to do is take the change, take the dollar change, and divide it by the first year, right? So I'm going to take the dollar change and divide it by 2010's balance. Okay, so watch me. I'll take 57,000 and divide by 117,000. Okay, and we want to express it in percentage terms. Okay, so that's a 49% increase. Okay, and we continue. For accounts receivable, it's the change of 12,000 divided by 81,000 from 2010. Okay. For inventory, it's 75,000 increase divided by 534,000 balance from 2010. And we just go down the list. Okay. And I'll just leave that positive. That means accumulated depreciation went up by 53%. And as far as total assets go, total assets increased by 14%. Okay. Accounts payable decreased. Okay. It went down by 28%. Income tax payable increased 13%. As well as common stock. Oops. And paid in excess went up too, right? retained earnings increased. Okay, and then of course that percentage change should be the same, 14%. Okay, so this is more internal, I would say. You're looking for your company's trend, right? Of course, you could take a horizontal analysis from one company and take one from another company and see, yeah, especially on the income statement, see how one company's income improved versus the other in percentage terms. But this is a good managerial tool as well internally, and then you can focus on the areas that didn't do as well as you expected them to do. Okay, so that's the start of 15, vertical and horizontal. I'll leave you guys to figure the ratios out before next week. You can go through the ratios, but I'm gonna save this for you. I think I recorded it again.